Well, good evening, students. I am going to use this opportunity and this medium to work out for you with detailed explanation the Westlake question. Now, a few students have done the question for themselves and they want me to go through this to see if they were correct. Now, if you have not done the Westlake question, please stop this video. Do not watch it any further unless you have tried it for yourself. If you do not want to do that, you run the risk of not fully understanding what is being done in each step. So as I said, if you have not attempted the Westlake question on your own, turn off the video now. Now, if you have tried the question, I applaud you because it is not one of the easiest questions in the topic. But once you have worked through this question with me, there is nothing that can come on any exam on this topic that you will not be able to tackle. So with that comment, I am going to begin the calculation. Now, I'm not going to be bringing up the question in view. I'm expecting you to have either downloaded it on another instrument and then you'll be watching it or watching this video in conjunction with what was downloaded or printed. Okay? Now, the first thing I want to comment on is that the questions for this tutorial are placed in a special order. And if you answer the questions in the order given, it will actually give you an approach that you can use for other questions like this. So the first question that you're asked to do, or the first question you're asked to solve, is what is the opening capital? What is the opening capital? Now you would have to have remembered that capital is the same thing as equity, and it is calculated by taking your assets, both current and non-current, and subtracting from that your liabilities, both current and non-current. So what I'm going to do now is to make a list of the assets, make a list of the liabilities, and then we can complete the computation to get at the value for capital. Now notice, the question is asking you for the capital at the start of the financial year. So the capital that we are computing, I am going to further define it as the opening capital. Well, I've done it already, the opening capital. So the thing to note is that the data that we're going to be using is found in the column dated January 1st. Okay? Now, one of the things that you must be wary of when computing the opening capital is that persons tend to forget the opening balance in the cash book. So I'm going to put that in red. I'm going to put that in red now. And it is a warning. Do not forget to include the opening balance for the cash book. And I think when I look back at the cash book, the first thing I note is that the opening balance is on the credit side. The opening balance is on the credit side. And that would mean that Westlake is starting the year with a bank overdraft. And the value for the overdraft is $45,000. So when we are working out the opening capital, we must remember to include the opening balance for the cash book. Okay, so with that song and dance, I'm putting the cash book value on the liabilities because a bank overdraft is a liability. So that is the first figure I'm going to put on the list. And the amount is $45,000. Now, I may not be calling the figures in the order in which they are appearing in the question, but I am going to ensure that everything that needs to be included is included and done so in the correct column. So we've placed our first item, the cash book overdraft. Now, we also have investment income owing. So investment income owing, I can describe that as accrued income. So the investment income owing, I can refer to that as accrued income. So you may be more familiar with that description. So that is the one that I'm going to use. All right. And that accrued income, if you remember, is an asset. And that is why I am listing it under the heading of assets. So that value is $3,000. Then there is opening stock. And that value is 8,250. We also had wages owing. And wages owing is also called accrued expenses. You may be more familiar with that expression. And the value for the accrued expenses, or more specifically, the wages owing, is $4,500. Now let me quickly finish the liabilities listing because that list is shorter. We have creditors. We have another expense owing, and they call it rates owing. So this is also another example of accrued income, accrued expenses. So the creditors figure is $4,100. The rates owing $3,000. And there's a loan, and at the start of the year, it was valued at $120,000. And the 10% in the description tells you what the annual interest is on that loan. So when I add everything, when I add everything, that figure comes to $176,600. So now we have our figure for our total liabilities. Now let me come over here and complete the listing for the assets. We have equipment, which is our non-current assets. We have machinery, also non-current assets, motor vehicle, another non-current asset, debtors, and we have a current asset, and finally we have prepaid expense. So remember, if an accrued expense is a liability, then a prepaid expense must be an asset. And so we will list it under the listing of assets. Let me put in the figure quickly. Equipment, 80,000. Machinery, 95,000. Motor vehicle, 40,000. Debtors, 5,000. And prepaid expenses, 4,600. So together, our new total is, for assets, $235,850. So now that we have our total assets and we have our total liabilities, we can now determine what our opening equity is. So the opening equity, also known as the opening capital, is $235,850 minus $176,600. So that leaves us with an equity figure of, let's see what that works out to be, $59,250. So that means we have now finished part A, answering part A of the question. So to quickly recap, it asks for the opening capital. So you must be using your opening balances dated January 1st. And I mentioned that you must not forget to put in your cash book balance, which in this question is a liability. It is a liability. So now I have all of my assets, which came to $235,850. I have all of my liabilities, which came to $176,600. And so our opening equity is $59,500 and $250. Okay, so let us move now to part B of the question. Now, part B of the question wants you to focus on total sales and total purchases. Now, from the fact that they have used the term total sales, will suggest to you that you're going to have to find a figure for credit sales. You're going to have to find a figure for cash sales, and you're going to add them together. Now, the same will apply for the total purchases. Again, you will have to work out what the figure is for credit purchases, and then you're going to add that to the figure for cash purchases. Now, from your previous lectures on incomplete records, you would have been introduced to control accounts. So control accounts will now be used to determine the value for credit sales and credit purchases. And when you look in the cash book already has the values for the cash sales. When I check the value for the cash sales, it comes to $60,000. And notice the cash sales is recorded in the cash book on the debit side. Remember now, all monies coming into the cash book is on the debit side. So the debit side of your cash book will usually give you your cash sales. Likewise, all funds leaving the organization as payments, all payments, including the cash purchases, will be recorded on the credit side of the cash book. So when I check over on that side, cash purchases totaled $35,000. So now we have a half of each of the figures. So now we need to focus on the credit sales and the credit purchases. When we find those two, then we're going to add them to come up with the total sales and the total purchases. So it means therefore that we're going to have to draft a T account. Let me quickly do one. So we need the top part of the T, the middle of the T, and we need to get the title. So we're going to do the creditors control account first. It doesn't matter which one you do first, really. So the creditors control account also has another name. It is called the purchases ledger control account. And this account is used to compute the credit purchases. So the first thing we need to note is the positioning of opening and closing balances. Now, because the creditors control account deals with creditors, it means that the opening balance for this control account must be on the credit side. So let's enter that information now. So the opening balance, which is the balance at January 1, was $4,100. Let's make some space. And the closing balance, which is a balance at December. Why am I not coordinating this? This is December 31. The closing balance is $6,750. Now, when we're doing control accounts, the first thing we need to consider is what are the opening and closing balances, and we have entered them for the creditors control account. The next thing we need to look for are the payments to suppliers. Now, if you look in the cash book on the credit side, you will see payments made to creditors. That's the figure that I'm after. Payments made to creditors. And this information is found in the cash book on the credit side. And you'll see that $22,650 was paid out during the year to creditors. So it means then that our credit purchases can be described as the missing figure. So let us see what we mean by missing figures. When we look on our debit side of our account, we see that it is going to be more in total than our credit side. The total on our credit side is $29,400. So if we're going to be working out missing figures to get at the credit purchases, it means that the credit side of the control account must also be saying $29,400. But the only entry in there right now is the opening balance figure of $4,100. So it means therefore that our credit purchase must be that figure to balance off the credit side. So let me do that. 29,400 minus 4,100. So it means that my credit purchases figure is $25,300. So now I can complete my total purchases figure. It's equal to the cash purchases figure, and that was $35,000. And we're going to add that to the credit sales figure that we just determined of 25,300. So it means that combined, your total purchases works out to be $60,300. Okay, so half of our question is answered. Now let us construct a similar thing for our sales ledger control account. I'm just going to change the heading for the T account. So these accounts can be called debtors control account or sales ledger control account. Now their balances are on the other side. So I'm just going to clean out the entries and put in new entries. So because debtors are assets, their opening balances have to be on the debit side. So the opening balance, which is the figure for January 1, happens to be $5,000. And the closing balance figure must be on the credit side, naturally. This is a figure at December 31st. And that figure is $6,500. December 31st, not 61st. So that figure is $6,500. Now the next thing we need to look for are any monies paid in by debtors. So any money collected in would naturally be on the debit side. It will be found on the debit side of the cash book. And when you run your eyes on the debit side of the cash book, you will see a figure for 55,000, which will be representing the money collected from debtors throughout the year. And this will come from the cash book. All right. Now, unlike the purchases ledger control account, there is another entry that we need to recognize. And if you look at the first note in the question, the second note in the question, it makes reference to something called discounts allowed. Now you should know that discounts allowed are associated with credit customers. So somewhere in the mix, this debtors control account must have an entry called discounts allowed. Now you should know by now that discounts allowed and receipts have the same effect on opening balances in that they reduce opening balances. So the discounts allowed entry must be seen on the credit side of this control account, and the figure is 3,450. So when we look on the credit side of this control account, we have a total of 64,950, which means that the debit side of the control account must carry the same balance. It therefore means that the credit sales figure, which is our missing figure, is that dollar value that will make the debit side of this control account total 64,950. So let's get that figure. So it's equal 64,950 minus $5,000. I think I put in 500. $5,000. So therefore we now have our credit sales figure. So we can wrap up now part B of our question. Work out what the total sales is. So from the cash book on the debit side, we found cash sales of $60,000. And we're going to add to that the credit sales figure that we worked out by missing figures of 59,950. So combined, the total sales for this company, this business, is $119,950. Good. So that marks the end of part B, which asks for total purchases, and it also asks for the total sales. And note that we had to use control accounts to arrive at the value for credit purchases, and we had to use control accounts to arrive at the value for credit sales. Good, so let us move on. Oh, let me not forget, because I credited the control account with discounts allowed, I need to put an account on the side called discounts allowed, because I have to complete the double entry for this. I don't want to leave it hanging. So because I credited the debtors control account, I am going to have to debit. I'm going to have to debit the discounts allowed account. Can't leave that out. So 3,450 is my figure. And I'm going to put here debtors control account as the other account that has the credit. Okay, I feel better now. So I've sorted that out. So let us move on now to part C. Now part C of the question is asking you to determine values for expenses for Westlake. Now you need to be aware of certain pieces of fact. The first thing you need to be aware of is that the information for the expenses will come from the cash book as well as the list of opening and closing balances. But here's the catch. If the expense that you see on the credit side of the cash book has no adjustments, what do I mean by no adjustment? That is no accruals or no prepayments. So if you look in the cash book and the expense you see, which is on the credit side of the cash book, has no adjustments, then that figure in the cash book is the true expense. Okay? So that figure can go straight into your trial balance, straight into your statement of profit or loss to compute profits. Now, when you look at the cash book, of all the expenses that are listed there, there's only one that falls in this category, and it is the rent. The rent, you see where rent was, I think it was $35,000 that they paid for rent. Just checking. Yes, rent was $35. And when you look in the list of opening balances on January 1 and the list of closing balances for December 31st, you see no reference to rent. So it means, therefore, that the true expense for rent is $35,000. Now, even though the question did not ask about rent, but I thought I should throw it in here because when we reach the last question, you will have to know this piece of information in order to properly complete your trial balance. Okay? So let us look at what the question is asking for now. It highlights 3 expenses: wages, office expenses, and rates. Now, there is something that you have to be aware of as it relates to expense accounts. Now, as you can see with the 3 expenses that they have highlighted, some have accruals and some have prepayments. Now, what I'm putting up here is a template that you can use for any expense to determine what the true figure for expense is that is going to go into the trial balance to work out net profits or losses. Now, the first thing you need to know is that in this expense account, so this is just a template that I'm creating. In this expense account, if the expense opens the year with money owing, meaning that you have accrued expenses at the beginning of the year, these accrued expenses are liabilities. So the opening balances for accrued expenses must be credited. All right? So regardless of what the expense is, if you're starting the year with an accrued expense, it must be debited. Likewise, if you have a prepaid expense, prepayments are assets. So if you're starting the year with an opening balance that is a prepaid expense, it means that you have to debit the figure. Okay? And by extension, if an accrued expense is credited for the opening balance, it means that its closing balance must be debited. So if you're closing the year with accrued expenses owing, then the closing balance must be on the debit side. And of course, naturally, if you close the year with prepaid expenses, it must be on the opposite side to the opening balance. So prepaid expenses closing balance must be credited. Now, the last two pieces of information that we'll need in this template is the payments. Remember now, when Westlake is paying out these expenses, they're going to credit the cash book. So all payments through the cash book must be debited. So payments through the cash book. So you're going to debit these payments in the expense account because in the cash book they are credited. So it means, therefore, that the true expense, which is the balancing figure, will have to be found, always found, on the credit side. Okay? So this is my template, and I'm going to copy it 3 times. One for the wages, one for the office expenses, and one for the rates. Then we're going to just fill in the information that is in the question and quickly arrive at what is the true expense to be used, and we'll be using that expense in the trial balance. So here's my first copy, second copy, my third copy. What are my expenses? The question asks for wages. It asks for office expenses. And it asks for rates. Now, in the question, the wages account started with an opening balance, an accrued expense. Remember, they described it as wages owing of $4,500. The office expenses started the year with a prepaid figure of $4,600. So I'm just going to pop that right there. And rates started the year with an rates owing of $3,000. So now we have put in the opening balances. The table also gives the closing balances, so let's put them in. So if the accrued expenses opening balance goes on the credit side, it means that those closing accrued expenses will go on the debit side, and the figure for wages at the end of the year was $6,000. For the office expenses, the year started off with some prepaid expenses of $4,600, which was debited. So they're going to close the year still with prepaid expenses of $7,200. For the rates, the year started with an accrued expense of $3,000 and ended with an accrued expense of $5,500. Now the last set of figures we're going to put in before we try to determine the true expenses are the payments that came in through this was just a template, so let me just highlight it so we don't get it confused. This is just my template. So it means, therefore, that the only figures that I want to put in that was provided were the payments through the cash book. And the wages, the cash book, they paid out $30,000 worth of wages. For office expenses, they paid out $24,000 worth of office expenses. And for the rates, they paid out $17,600. So don't get caught in an exam if this question comes up, thinking that because you see rates and office expenses on the credit side of the cash book, that those figures are the true expense. They are not, simply because there are opening, prepaid, and accrued expenses involving those expenses. So you have to do these tier accounts to make sure you're picking up the correct figures for your expenses to complete your trial balance, which was the last question we're going to do. All right, so Let us pretty up our figures. Let us pretty up our figures. Put in the thousands so I can see what we're doing. That should not have happened. Likewise for this, let's pretty that up so we can see what we're dealing with. So the only thing we need to do now is to balance off the account so that we can determine the actual expenses for the period. So let's start with this one. For the wages, our combined figure on the debit side is 36,000. So it means therefore that over here our total has to be $36,000. So for that to happen, it means that the true expense, oh, by the way, this is zero. There was no prepaid wages. Start to finish, there was none. So the missing figure that we are looking for is a true expense, and we find it by subtracting the 4,500 from the 36,000. Let's do that. So it means that the true wages expense is $31,500. Okay. Let's do the same for the office. Total on the debit side is 28,600. So the credit side must also be showing that. And the only way it can be showing that is if there's a true expense of $21,400. Again, there are no figures for accrued expenses for office expenses. That's nil. And lastly, for the rates, there are no prepaid figures, only accrued figures. So let's zero those. Our total on the debit side, 23,100. So on the credit side, the same thing must apply. Hence, our true expense will be found by subtracting this from 3,000, subtracting 3,000 from the 23,100. So our true expense, as the question is asking us to find, is 20,100. So here are the answers for part C. 31,500 for wages, 21,400 for expenses, and $20,100 for rates. All right, moving along. Now there is income. We just spent a good while looking at the expenses, but there is income. And the income in this question is investment income. So don't mind the name. Don't mind the name. And the income is income. It's going to be handled, all right, in that way. Now, again, I'm borrowing the template, but we have to switch everything around. We have to switch everything around. So if we have prepaid income, remember now, prepaid income is a liability. Prepaid income is a liability, so we're going to find it on this side. So if our income starts the year with prepaid, in a prepaid position, it's opening as a credit balance. And if it closes the year in that same state, then the prepaid income closing balance will be on the debit side. If we have accrued income, that is an asset. So let's change this up. Accrued income, if it is an asset, will open with a debit balance. Likewise, if it's accrued income closing the year, you'll have to record the closing balance on the credit side. Now, when we're talking about income, we're talking about cash coming into the business at some point. So if we look in the cash book, we should look for money received from investment. It will be on the debit side. So it means that we have to record this on the credit side. Money received from investment. And this is coming from the cash book. So it means that our true income is on the other side to the expenses. So the true income, well, it's not coordinating this evening at all. So this is our objective, to find out what the true income is. This is what question D wants. So the investment income, let me change it to investment income, starts the year with investment income owing. And remember, we had used it as an asset when we were computing the opening equity. So this figure is $3,000. It also closes the year as an accrued income of $5,500. $22,500 came into the bank account, or the cash book, sorry, as monies from the investment. There was no prepaid income, so that's nil at the start of the year, and likewise nil at the end of the year because there's no prepaid income. So it means, therefore, that we can now calculate what the true income is. And we're going to use the same approach as we did with the expenses. We're going to find the total for the one side. And then we're going to make sure that that total applies on the other side where the missing figure is needed. And that total must be 28,000 to match the credit side. So it means that our true income is 28,000 minus 3,000. So our true income is $25,000. So that wraps up our part D of our question. I'm going to change the color on this so we don't confuse the public. All right. Now we go to part E. So we'll soon finish the question. We've been at this for 48 minutes now. So we've been here for a while. And what is the question asking us now? Apparently, Westlake sold an asset. And so it is your job to determine whether that sale has created a gain or a loss on disposal. Now you need to know, as an accounting student that once you sell an asset, you must create a disposal account. Let's create that T account. So I'm going to borrow from my template. Let's do this. Let's borrow this one. And I'm going to call it a disposal account. Let us see what goes into a disposal account when you are making a sale of an asset. The first thing that you're going to put in your disposal account on the debit side is the cost or net book value of the asset being sold. Now, when you think of it, the asset was previously sitting in an asset account with a debit balance. So if you're going to sell any of those assets in that debit balance, you're going to have to credit the asset account, which means that you're going to have to debit the disposal account. And you were told in the question that the net book value of this asset was $15,000. Now, if we were booking the cost, then we'd have had to book the accumulated depreciation by removing it from the records, removing the depreciation on the asset being sold. But because we're using net book values, the depreciation is mixed up with the cost in that figure. So we don't have an accumulated depreciation to separately book. Now, what we're going to need, however, is the disposal proceeds, meaning the money that Westlake would get from selling the asset. Now, where would this money be recorded? If Westlake is getting cash for selling the asset, we must look for it on the debit side of the cash book. And when we look there, we see a figure for $11,500 as sales proceeds from the disposal of the asset. And this will be coming from the debit side of the cash book. So I think at this point we have all of the entries that we will need, and we will see that the debit side of this account is bigger than the credit side. Now, what is the implication here? Now, just look at the logic of it. If the asset is valued for $15,000 and it is sold for less than what it is worth, it means that our balancing figure must represent a loss on disposal because you're selling it for less than it is worth. It is worth $15,000. That's a net book value. But you're collecting only $11,500 from that. So it means that the loss on disposal of this piece of machinery is $3,500. And this loss is an expense. So you will see it recorded in the trial balance as a line item under the debit column because losses are seen as expenses. Now, Part F deals with the fixed assets. And anytime you think of fixed assets in incomplete records, you need to think about depreciation. Now, you were already told that one piece of machinery was sold. But the thing to note is that look at what the question is asking you to look for, the depreciation charge. Now, I want us to take a look at each asset, what its value was at the start of the year and what its value was at the end of the year. The equipment was valued at $80,000 at the start, but its value fell to $78,000. Now, if there was no disposal or purchasing of any equipment, it means that that fall in the value must have been because of depreciation. The same applies for the motor vehicle. The motor vehicle at the start of the year was valued. It had a net book value of $40,000. Remember now, net book value means that the cost and the depreciation is mixed up in the same account. So if the value falls to $36,000, it means that the difference is because of depreciation. But you have to be wary of the machinery account because the depreciation is going to be affected by the disposal figure we just used in the disposal account. So again, I am going to copy T accounts from somewhere. Let me copy it again from up here. So I'm going to build 3 T accounts. One for equipment, one for machinery, and one for motor vehicle. Let's label them accordingly. equipment, machinery, and motor vehicle. Now, all of these are non-current asset accounts, and their opening balances will always be on the debit side. So let's put in their opening balances and by extension, their closing balances. So for the first one, the opening balance was $80,000. And I'm just going to copy the description and quickly put in the values for the rest. 95,000 opening balance for machinery and 40,000 opening balance for motor vehicle. The next thing we need to do now is to put in the closing balances. Again, these are net book value figures. For equipment, we have falling value to 78,000. For machinery, somebody's protesting. So for the machinery, the falling value is $75,000. And for the motor vehicle, which is spelled with an E at the end, that closes with a value of 36,000. But let me focus on the equipment and the motor vehicle first because they're straightforward. For the equipment, the falling value is attributable to depreciation. So it means, therefore, that the credit side must total to 80,000, and so depreciation expense is the reason for the fall. And how do you find that missing figure? It is 80,000 minus 78,000. So for equipment, depreciation expense is $2,000. Again, let me pretty it up a bit by formatting it. The same thing with the motor vehicle. The debit side is the larger side. So the credit side must reflect that total. So the difference, again, is depreciation. And this time the figure looks like $4,000. Good. Now the last asset that we need to look at is machinery. And the reason why I left it for last is that, if you recall, we had moved a $15,000 to the debit side of the disposal account. That means that the credit was somewhere over here. So this 15,000 was sent to the disposal account when the asset was sold. So now we have to take that figure into consideration when deriving our depreciation. But still, the left and right side must come to $95,000. Where did it go? Sorry about that. So my missing figure is depreciation again. And it is found by taking the 95,000, keep jumping. It is found by taking the 95,000, subtracting 15,000, and subtracting 75,000. So the depreciation expense is $5,000. So now we can lump everything together in terms of the total depreciation, because that is what the question was asking for. What is the depreciation expense? So the total depreciation is equal to 2,000 plus 5,000 plus 4,000. $2,000 plus 5,000 plus 4,000. That sounds like $11,000. Okay. Good. So now we have answered part F, and we are just past the 1 hour mark. We're wrapping up soon. So let us look at part G. Part G of the question is the final point. And after 1 hour of talking and calculation, we now need to put every single thing together. We need to put all this information together to generate a trial balance for Westlake. My spelling has been off. So it's Westlake's trial balance. So I'm going to put the name there. And it's going to be as at December 31st. It didn't give out year. Now what we do know is that in our trial balance, we're going to have a debit column. Ooh, a debit column and a credit column. And some dollar values somewhere in the mix. All right. So remember now, at the end of the day, all of our debits that we're going to put in must equal all of our credits. Now, the first figure that I usually put in a question like this is the opening equity. We spent quite a while in part A of the question working that figure out. So the opening capital, you always see your opening capital figures in your trial balance. You may see the word capital but not realize that it's the opening capital. And when I look back, that opening capital figure was calculated to be $59,250. Okay, so we have in our first figure. Now, when we look at our cash book, the cash book had a closing balance, a balance CD, which happened to be on the debit side. So when you bring that balance down, it's going to go onto the credit side, which means again that Westlake's cash book closes with a bank overdraft. And the overdraft figure, the balance CD figure, was $106,000. Now, the easiest way to complete or put as much information into this trial balance is to go back to the table that showed you your list of closing balances. So I'm going to now take that information and use it to help me to complete the trial balance. But that is not all. because in our workings we created new figures that must end up in the trial balance. But let us just quickly use the figures from the table given at the start of the question. So we had wages owing. And wages owing is a liability, so it goes in the credit column, $6,000. Then we had investments owing, which is accrued income, which is an asset, which goes in the debit column. And the investment owing was $5,000, 5,500. Now the stock figure that we're going to use is the opening stock. The closing stock figure that you were given, you will ignore it. Why? Because that figure was derived by a stock count. It was not derived by any double entry. So we're going to throw away the closing stock figure and we're going to reuse the opening stock figure of 8,250. So you remember in the past when we gave you trial balances to work to determine financial statements, you were always given the opening stock in the trial balance and the closing stock as a note. Because that closing stock figure that was derived was not derived through tier code. It was done through a stock code. So we will ignore it. So the figure we're using here is the opening stock figure of 8,250. Then we have the creditors, and the creditors closed with $6,750. So we're just putting back the figures straight from the table. The equipment was $78,000, and it is an asset. The machinery was $75,000, and the motor vehicle was $36,000. So let's put those in. The debtor was $6,500, and as you know, that is an asset. Then expense prepaid was $7,200. And then rates owing was $5,500, which is a liability. And then the last thing we had was the 10% loan. So these figures that we just used came straight from the table. 10% loan was $82,500. Now the figures that we're going to now use to wrap up the trial balance, I'm going to be jumping back and forth to pick them up. So I hope you won't get too busy because I'll be shifting screens. I'll try and shift it slowly so I don't get you dizzy. Now, let us go back to part A. In part A, it provided us with the opening equity, which we have already used in building the trial balance. So there's nothing else here that will help us to build that trial balance. So let us move on. From part B, we had worked out the total sales and the total purchases. And those two figures, we need them. Those two figures, we need them. So I'm going to pick up 60,300 for purchases. I'm going to pick up 119,950 for sales. And let us not forget our expense called discounts allowed of 3,450. So part B of the question gave me 3 pieces of information to throw in my trial balance. So let's go back down there and put them in. So we're going to put in our sales figure, which is made up of credit and cash sales. And that goes in the credit column because it is income. 119,950. We need one more figure. 119,950. And then our purchases, and that purchases figure is expense. And so it goes in the debit column, and that figure was 60,300. And the last figure from note B that we're going to use is our discounts allowed. And so that's our 3 items from part B. Let's go back up now to part C to see what we can get out of that. Now, even though part C didn't ask you about the rent needs to be included in the trial balance because it is one of the expenses that were incurred during the year. So apart from the rent for 35, which you're going to put in as an expense, we're going to pick up wages of 31,500. We're going to pick up office expenses of 21,400, and we're going to pick up rates of 20,100. And while we're at it, we're going to pick up an additional income of $25,000. So let's go back down and put those in. Wages expense. Now the wages owing now, the real expense is 31,500. Then we had the office expenses, and that figure was 21,400. And then we had the rates, and the rates figure was 20,100. And finally we had the rent, which had no adjustments. We're taking the figure straight from the cash book, 35,000. And while we're at it, we also recognize investment income, the true investment income, which turned out to be let's go back and look. The investment income was $25,000. So let's throw that in. It's income, so it's going to be under the credit column. Now, there was a loss on disposal for the machinery, and that loss, if I remember, was $3,500. Okay, so we had worked it out here, and this is a little figure that we're picking up to put in the trial balance. Okay, now we already picked up the closing balances in the trial balance for these assets, but we now need to pick up the expense of 11,000. So I'm going to scroll down now and put in depreciation expense, and that figure was $11,000. Good, we're making progress. So let me see if there is anything else that I have missed out. Let me see if there's anything. Oh yes, the loan interest. The loan interest. There was an 8,250, I think it was. 8,250 of loan interest that was paid from the cash book. And let me see what my total now looks like, because if they agree, our question is finished. If they don't agree, I'm going to have to audit my question, my solution, and find out what went wrong. God is good. They both agree. So, ladies and gentlemen, after 1 hour and 15 minutes into this video, we have now come to the end. We have answered all questions from A to G. And so I trust that you will go over it as often as you need to, especially zooming in on the special sections that you might have a challenge with. So I hope that you were honest enough to have stopped the video. Try the question yourself before coming back to look at this. All right, and I wish you all the best with the remaining topics for the semester. And I'll see you in class next week. Thank you.